Ladies and gentlemen, good day and welcome to the Q2 FY23 earnings conference call of Windlas Biotech. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Hitesh Windlas, Managing Director of Windlas Biotech Limited. Thank you, and over to you, sir.
Thank you. Good morning, everyone, and thank you for joining us today for our financial results for quarter and a half year ended September 30th, 2022. We have uploaded the press release and investor presentation on our website as well as on the exchanges. I hope everyone must have had an opportunity to go through it. Initially, I would like to discuss key company highlights for Q2 and H1 FY23, followed by financial highlights of the company, which shall be shared by our CFO, Ms. Komal Gupta. The company reported a top-line growth of 15.2% for Q2 of FY23, where H1 FY23 clocked at 11.7%. This was mainly on account of robust growth of 17% in Q2 for CDMO vertical and 47% in Q2 for trade generics vertical. The bottom line grew at an even faster pace, registering a growth of 47% both in Q2 and H1 FY23. The company increased its presence of chronic and subchronic medicines and complex generic products, since these continue to offer a large growth opportunity for both top and bottom line. Due to the cost-plus model in CDMO and higher gross margins of trade generics vertical, the company has been able to demonstrate stable profitability despite a highly variable input cost environment linked to global supply chain volatility. EBITDA margins expanded by around 70 bps YOY, indicating an improvement in margins despite inflationary and volatile business environment. The company is using its supply chain and operations capabilities to strengthen its role as a partner to its customers, as opposed to just being a vendor. These efforts have ensured that we remain a valued first choice for our various pharmaceutical companies in multiple therapies such as diabetes, cardiology, and gastro space. Our new product launches have enabled our CDMO customers in gaining an early mover advantage in many of their core chronic therapies. We continue to enhance this value proposition by continuing to invest in new product development and enhanced just-in-time delivery. Company's various initiatives for CDMO vertical include fresh patent expiry launches, expanding wallet share from current customers, attracting new customers, and introducing distinctive products underpinned by top-notch R&D and ongoing capex for injectables. The government's trust on quality will further facilitate consolidation and benefit large players like Windlas Biotech. Windlas is experiencing excellent growth in trade generics segment, which is being supported by a rapidly expanding distributor network. The trade generics market is still largely underpenetrated and offers significant growth opportunity. The primary external tailwinds for forthcoming growth phase of domestic trade generics verticals are predicted to be rising consumer demand for high-quality generics and government measures that will enhance generic adoption and reliance across India. Branding, channel expansion, new product release, and regional expansion are additional internal growth factors. While the company has been filing numerous dossiers and making sustained efforts in the export space, this growth is largely stag-ended, and we are yet to reap the benefits of most of the work done here. Moreover, with the recent successful completion of SAFRA and EU GMP audits, which have permitted access to the newer and regulated markets, the exports vertical is also primed to flourish. In addition to these business updates, I would like to inform you that the Board of Directors of Windlas Biotech Limited have approved a share buyback program under which The company is planning to purchase up to 25 crores of the outstanding shares. There will be no participation from promoters in this buyback program. In order to maximize value for our shareholders while also expanding our company and keeping a strategic reserve of potential inorganic growth opportunities, we and Windlas Biotech maintained a disciplined and prudent capital allocation approach. We are dedicated to making thoughtful capital investments where we believe we can do so. I will now request Ms. Komal Gupta, our CFO, to discuss the financial performance highlights. Over to you, Komal.
Thank you, Hitesh. Good morning, everyone. The business environment's persistent interruptions and geopolitical challenges did not have any major effect on company's financial performance, which has remained sound. During the quarter, the company's competence and operational tenacity were amply demonstrated. The company was able to improve its margin profile with gross margins for Q2 coming in 154 bits higher YOY and corresponding EBITDA margin closing 67 bits higher. For Q2 FY23, EBITDA margins stood at 12.1% as against 11.4% YOY. PAT for the quarter stood at 12.2 crores as against 8.3 crores, a growth of 47% YOY. I'll now take you to vertical-wise highlights. CDMO vertical. Q2 and H1 FY23 revenue for CDMO vertical stood at 106.6 crores and 202.1 crores, up 17 and 8.1% YOY respectively. CDMO vertical contributed approximately 80% for Q2 and H1 FY23 to the consolidated revenue. Trade generics vertical. Q2 and H1 FY23 revenue for trade generics vertical stood at rupees 23.1 crores and rupees 44.5 crores, up 36.8% and 52.2% YOY respectively. Trade generics vertical contributed approximately 17% and 18% for Q2 and H1 FY23 respectively to the consolidated revenue. Exports vertical. Q2 and H1 FY23 revenue for exports vertical stood at rupees 2.5 crores and rupees 4.4 crores, down 54.1% and 42.3% YOY respectively. Exports vertical contributed approximately 2% for Q2 and H1 FY23 to the consolidated revenue. The company has utilized 100 crores, which roughly translates into 65% of 153.1 crores raised during the IPO on various items listed in the prospectus. Additionally, the company has begun utilizing the funds for upcoming injectables capex in terms of ordering machinery and getting to mechanical completion. The business's net cash position is robust, and as previously indicated, the company wants to play a significant role in market consolidation, so it has a substantial reserve for prospective inorganic growth opportunities. That's all from our side. We can now begin Q&A session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ashay Jain from Jain Capital. Please go ahead. Please go ahead with your question, Mr. Jain. Your line is unmuted.
Yeah. Hi. Hello. Am I audible?
Yes, you are. Please go ahead.
Yeah. So I have a couple of questions. Firstly, in regards to injectables, so it's mentioned that mechanical completion. You could throw some light on the current status and by when can we expect the commercial rolling out of products from the injectables facility?
Sure. So we had originally expected that we will be able to start commercial production in March of FY23. That was based on the machines that were expected from China, and we had to change our vendors during the interim because of significant delays from Chinese supplier. So we now are procuring the new machines from Indian vendor, and we will be completing the mechanical completion, which means that the plant is handed over to quality, and the media fill will start in March, and that is a period of 3 to 4 months from that point where commercial production can typically start.
Okay, that's helpful. Secondly, what is the timeline on utilization of proceeds from the IPO?
So most of the proceeds that are remaining on the injectable capex front are associated with these payments only, and we are expecting that we will be spending almost all of that before the mechanical completion date of March 23.
Okay, understood. Yeah, that's all from my side. Thank you.
Thank you. Participants who wishes to ask a question may press star and 1. The next question is from the line of Viraj Shah from Shah Investment. Please go ahead.
Hi, sir. I have a couple of questions. Sir, going forward, do we plan to have more sustained exported share in the regulated markets?
Viralji, we have, as we have mentioned earlier, in the regulated market space, we are not pursuing the US market as of now, until the foreseeable future at least.
Okay.
And of course, we have mentioned also that this is because of the margin erosion in that market, which has been very significant. And we have also mentioned that our plant 4 is now EU GMP approved as well as South Africa SAFRA authority approved. So these two opportunities we are still pursuing. And, so this is where we are going to use our facilities for exports. So ROW has been our mainstay earlier. Now we are adding, those markets, PICS markets, which are accessible because of our EU GMP inspection approval.
Okay. And sir, what is the steady gross margin that we are targeting?
Komal, do you want to take that?
Yeah. So the gross margin level that we are currently at is, if you look at H1 versus H1, we are already 1% higher. So 36% is the range which we are currently at. This might slightly increase further with trade generics vertical contributing more to the overall revenue from operations. So 35 to 37%, or sometimes slight higher, is what we expect to continue.
Yeah. Okay. Thanks. I'll come back in.
Thank you. Anyone who wishes to ask a question may press star and 1. The next question is from the line of Prachi Sharma from Ace Investor. Please go ahead.
Good morning, sir. I just have a couple of questions. Firstly, can you provide the revenue breakup of complex generics versus conventional products for H1?
Sure. Komal, you want to take that?
Yeah. Yes. So for H1, we have complex generics of about 77.5% for H1, and Q2 it is around 80%.
Okay.
Yeah.
And the conventional products?
So rest is conventional, 20% for Q2.
Right. My second question is, what is the top 10 client concentration as per H1? Also, what is the number of our top customers?
So I can give you top 10 customers contribution percent. Sharing the names, we might not be able to do that. For H1, the top 10 customers contribution is 45% for H1, and for Q2 it's even lesser, 43%.
Okay. That's all from my end. Thank you so much. Thank you.
Thank you.
Thank you. Ladies and gentlemen, to ask a question, you may press star and 1. The next question is from the line of Gaurav Sood from Karam Capital. Please go ahead.
Yeah. Good morning, Hitesh. So I have a couple of questions. One is around the performance of the exports on a year-on-year basis. The exports have shrunk from a lower base. So what's exactly happening on the export front? Also, in your notes, you have highlighted that exports, there's a significant opportunity lying ahead. So what is creating that opportunity, and how do you expect the exports to pan out over the next couple of years?
Sure. So Gaurav, sort of our guidance on the long-term guidance has been that at the time of listing that we will roughly double the CDMO business, triple the trade generics business, and quadruple the exports business in 5 years. When we look at the exports vertical, although we are on a very small base, but there have been some small disruptions. Like, for example, our supplies to Sri Lanka, we ended up stopping because of the currency crisis and payment crisis in that country. Our customers in Myanmar were struggling to renew some of their import permissions because of foreign exchange concerns at their side. So we wanted to be conservative, and we ended up saying that better to not supply and get our money stuck. So there will be some of these small variations, but overall the markets on export side that we are targeting are all those markets which have very, very low domestic production. So these are the Southeast Asia, the Africa, CIS, and with our EU GMP approval, we are also looking to see if we can get into the Middle East markets. So, and these are very, very rich markets in terms of the kind of products we are looking for going forward, the growth rates over here. And although some of them have different incubation periods, so anywhere from 1.5 to 2 years minimum, the country incubation periods are there. And we are looking at various ways to, accelerate and, tap these opportunities with our product selection and market selection decisions.
So, Hitesh, then would you imply that this shrinkage in exports is a one-off in this quarter, and or will this shrinkage continue because the crisis that was there in Sri Lanka or Myanmar or maybe the other countries, and that still continues to some extent? So when do you expect the exports to start growing again for you?
So, Gaurav, I think the exports vertical we should look at a 5-year point, because we are at such a small base right now that quarter on quarter or even year on year results will not be there unless we do some kind of acquisition which then adds something. And so if we keep that aside for a minute, then my sense is that we spoke about growing this business to 3x of its original size at 25 crores. So 75 crores is what we want to target by 2025 end, and that's what we are still gunning for.
Okay. So yeah, and the other point was around inorganic acquisition. So any progress on that front? Any candidates that you are seeking out?
Yes, we have been actively evaluating. In this quarter, actually, we in fact conducted legal, financial, and quality diligence on one asset, and we found some adverse, things that we, made up. We decided not to pursue that. In fact, some of those diligence costs are also included in our this quarter's P&L. We are continuing to look at several opportunities, and hopefully once we are at a stage where we can confidently go ahead on something, I will be able to share.
Sure. So, and the final question is around the trade generics. How is that business scaling up, and what are the current monthly run rates in that business right now?
Sure. That business is scaling up very, very nicely. As you saw, maybe in Q1 of this year, we had almost, greater than 70% kind of growth, YOY. And this time we are talking about 47%. So definitely, very significant growth is there. And this is a very, very large opportunity, in fact, for India. If you look at, the landscape, there are only about 400 to 500 odd towns and cities which have population of more than 1 lakh people in India. And then there are villages and kasbas which are more than 6.5 lakh, and almost 70% of India is residing there. And these kasbas and villages don't even have enough doctors. So the traditional model of branded generics to employ medical reps and send them to meet all these doctors does not work in this very big hinterland. And this is where trade generics as a model, has existed and now is taking up very, very well. And our approach is also very unique. We are looking at it as a AAA approach, authentic products, affordable prices, and accessible medicine. So we are offering the same quality medicines that we are offering to our customers in CDMO. We are offering affordable rates, and we are significantly expanding our distribution network to get our products into the hinterland. And I believe this is also seeing overall market growth as well for all the players. And at Windlas, definitely we are very excited about this space.
So, sir, then on the trade generics, typically in terms of the retail price, what is the difference on a like-to-like basis in terms of prices with branded generics that are out there?
So this difference varies very, very much across different products and different categories. We have almost 200 different products that we have in trade generic segment.
Just a range of discounts to the branded generics, like the lowest price branded generics.
Typically, when a retailer is selling a trade generic product, even though the MRP may be even equivalent, in order to substitute, he's giving a 15 to 20% discount on MRP to the consumer or to the patient. So the way the economics line up, you can assume roughly about 20% saving for the consumer, and of course then that's how the sort of value chain adds up.
And do these trade generics, are they some kind of a brand is built on top, or it's just the salt that is highlighted in this packaging?
No, there is definitely a brand. They are, in fact, when you look at a trade generic product and a branded generic product, you cannot differentiate them. Each one has the same kind of labeling, the branding, and everything. The only difference is that in a branded generic product, it is being marketed by medical reps to physicians, while trade generics is being sold through the channel through substitution. What we are doing at Windlas is actually unique. We are actually doing an umbrella branding approach where we are branding Windlas generics, to the in the space, and trying to create a recognition for our AAA approach.
So when you say Windlas, so the mother brand is going to be Windlas generics across these bouquet of medicines.
That's right. That's right.
Okay, and largely the difference between this and the branded generics is the way the distribution happens. Otherwise, in terms of packaging, they look quite similar. So.
Yeah, there is only the distribution that is different. There is so obviously the margins for the channel are different, and there is obviously the approach is that in trade generics you are not incurring the cost of employing medical reps and large sales forces. Some of the largest companies have more than 12,000 reps today, so none of that is the expenditure.
And the other aspect around these trade generics is that these will be kind of OTC products. They won't require a doctor's prescription to be sold.
No, so these are when we are of course selling to our stockists, and the stockists are then selling it to retailers. A lot of the villages and kasbas where these are sold, there are no doctors. So patients actually are catered to by the pharmacist himself, and a lot of the products that are sold in this vertical are also not highly sophisticated molecules. They are more the primary care kind of products. But these are essentially either a doctor has written or a dispensing doctor himself is buying in bulk from the retailer and then dispensing it to the patient himself. So he is also saving on some margin by buying in bulk from the retailer and then dispensing. Or it is a substitution by the retailer who is doing it on his own, accord. Okay.
And yeah, the final question is, since you sell the same set of drugs under your CDMO operation, how do the customers take your ability to build this trade generics? Is there any conflict of interest that they see, or how do you handle this question from their side?
No, so most of our CDMO business is in the branded generic space. Although some trade generic customers are also beginning to buy from us in CDMO, but this question usually doesn't come up because even in whether it's branded generics or trade generics, each molecule today has more than 100 different companies marketing it. So it's a very hyper competitive market in some sense, and each brand is not really very little cannibalization risk that customers perceive from that perspective. And almost all players.
So in branded generics, the brand is much more important than any additional production being sent into the market.
Yeah. Their doctors, their association with the doctors is what gets their revenues increased. So, so for example, we manufacture the same product for, let's say, 5 or 7 different branded generic companies also, and there is no issue. And similarly for us, when we are manufacturing a certain molecule, there are, like for example, pantoprazole, domperidone, there are more than 250 brands in the market. So it hardly matters whether, how many of them are being manufactured there. So, customers don't see that as a threat at all. And if you look at all CDMO companies, whether it's Windlas or, other top 5 players, all of them have their own trade generics verticals as well.
Okay. So if they have trade generics verticals, so in case of Windlas, do they have similar kind of revenue share from trade generics, or Windlas is ahead of them, at least to the top 5 players?
I would believe that we will be a significant player this year. Since it's a new vertical for us, we launched it about 5 years ago. We will be a significant player for sure.
So, yeah. Thanks a lot, Hitesh. All the best for the coming quarters.
Thank you.
Thank you. The next question is from the line of Miten Latharia from Fractal Capital Investments. Please go ahead.
Yeah, hi, good morning. Could you help us with the headcount that we would have in the export vertical, both on the product and marketing side now versus what we would have had a year back?
Sure. In our exports vertical, we have about close to about 7-8 people with a mix of backgrounds in business development, regulatory dossier preparation, and some of the dossier preparation work we also outsource to regulatory companies. And that sort of we are not actively sort of marketing in those countries and traveling unless you have the registrations. You don't want to add the sort of marketing costs until the registrations are there. So that's the size of our business development team and export vertical team. A lot of it is sold to distributors, and like in some cases in Vietnam and in Myanmar, it is sold to a marketing partner. So the marketing partner is sort of all thereafter investing in building the sales in that locality.
See, the export opportunity is just scratching the surface in terms of the export opportunity. So just from a capital allocation perspective, would it not make more sense to invest more aggressively on that front? Of course, your buyback is very much appreciated, but just wanted to sort of get your thoughts around why would we not be more aggressive on that front?
So, Mitesh, we definitely are looking for opportunities to acquire market authorizations and to acquire, because the whole story for export starts post you having a market authorization for a product. And it takes from filing to approval, it is a 1.5 to 2 year, period which cannot be cut short. So, we are looking at avenues to do this in a different manner rather than sort of, prepare dossiers and do it all organically. We are evaluating few opportunities like that for sure.
Great. That's all I had. Thank you very much.
Thank you. Participants who wishes to ask a question may press star and 1. The next question is from the line of Anusha from Srinath Securities. Please go ahead.
Thank you for the opportunity. So wanted to understand, we have observed a lot of patents that are expiring and have expired in 2022. Are any of those products in our pipeline, or have we received any new BGCI approval?
Yes, definitely. We are constantly receiving BCGI approvals every quarter and launching those products. In this quarter, in Q2, we launched a combination of sitagliptin with a change-release metformin. Earlier, this was not available in the market, and we are one of the first few people who have brought this to market. The earlier combinations were sitagliptin plus metformin plain, not sustained release. So these are some product, sort of enhancements that we are bringing. In terms of upcoming patent expiries, I think one significant one that everybody is looking at in the industry is the valsartan sacubitril, which is coming off in January. And I think then thereafter, several molecules.
In August, we have linagliptin coming.
Right, linagliptin. So some of these are there, which are in our core therapeutic areas, which we are focused on.
Okay, sure, that helps. So wanted to understand what is the status of our pilot API facility? I mean, do we have any plans to produce API in-house now?
I'm sorry, plans to reduce what?
Plans to produce API in-house.
I see. Okay. We are producing API in-house for because we have a pilot plant which can do commercial production in our plant 1. And some of the new launches strategically we have done from sourcing manufacturing that API within our own this thing. And we also have a API process development lab which we have been running for almost 7-8 years, where we have developed efficient technologies which we are going to scale outside. But so far we have looked at API as a more of a strategic place where if those patent expiry products are not there and small volume production is hard to get from outside, we are doing it in-house. We are not looking to, as such, as of now, specifically jump into the API business.
Okay. And so what is our current capacity utilization?
So our capacity utilization as of now is about 44% for Q2 of FY23. 44.2.
Okay. So by when do we expect to reach 60-65%?
So with this current capacity, we should be able to do almost 600 crores of revenue, and we anytime that we hit about 50-55%, we will start creating capacity for another unit. The idea is that in our business, in a multi-product oral solids manufacturing, the global maximum that people have reached is not more than 65%. So very rarely you can go above it, but then on an average annual basis, the utilization number is around 65%. So you have to look at it from that perspective. The maximum is 65%, and we don't want to reach the maximum. In CDMO especially, we have to create capacities in advance. Right now, we have enough to cater to take us to almost about 600 crores. And as we see this number inching up, then we will, incrementally create more capacity to receive the growth.
Okay. Thank you, sir. Wish you all the best.
Thank you.
Thank you. Participants who wishes to ask a question may press star and 1. The next question is from the line of Priyanka Shah from NM Securities. Please go ahead.
Thank you, sir, for the opportunity. So I have a couple of questions. Have the input costs stabilized, or do we see further softening? If you could throw some light on the raw material scenario.
Sure. Yes, Priyanka, we have seen input costs stabilizing. Definitely from Q1 to Q2, there is a stabilization that we are experiencing. And in some, at least what we can say is the volatility is coming down. Predictability may still not be there, but volatility is definitely coming down.
Okay, sir. And what do our current receivables, payables, and inventory days stand at? Like our inventory has significantly increased in the last 6 months. Are we facing any issues in inventory management?
So, for inventory, there is increase in inventory days. You are right. This is because we have started maintaining safety stock levels for critical raw material and packing material for ensuring higher sales, the growth that we have been able to deliver in Q2 of FY23, and we hope to continue the same. It has enabled us that, number one. Number two, as you see for trade generics, the sales have been improving, so we have to maintain higher CFA stock levels. So these are basically the reasons for increase in inventory days.
Okay, that is helpful. Thank you.
Thank you.
Thank you. question is from the line of Nitin Agarwal from DAM Capital. Please go ahead.
Hello. Morning, Hitesh. Hitesh, on the CDMO business scale-up which has happened in this quarter, can you just sort of highlight any specific triggers? Because, in the past, we've been talking about volume growth in the industry being sluggish, and that continues to be the case still. I guess, volume growth in the broader IPM has not quite picked up. So what has drove the traction for us in this quarter, and how do you see it now going forward? Is this 105, 110 new base for the business?
So, Nitin, I think so that's a very good question. You're very right that on an overall market level, the volume growth has not been so much. The Q2 CDMO growth is somewhat led by new product launches. Actually, we launched some products in urology segment, which have picked up nicely, and we were able to win some new accounts. And so that has given a boost. And I think that, when the volume growth is not very high, our customers also look for new innovative ideas. And that is where, we are trying to sort of differentiate ourselves and bring new products with DCGI approvals, with bioequivalence studies, and sometimes even clinical trial studies. Just a week back, we got a very important product approved. So these are the ways in which, we become a valuable partner to our customers, and that's how we are looking to drive. Now, of course, these are sporadic, so you can't really predict the approval timeline and or the volume of a certain product that you're working on. But the products have been chosen in such a way that they should have, give a unique edge to our customers when they go in front of the doctors and, showcase themselves. So that's how some of this growth has come, and we want to continue that for sure.
And on that point, so you mentioned that you just launched Simva Plus Metformin extended release, sustained release rather. So so on that, were we the first ones to get an approval from DGCI to launch this product, and how many customers did you license this product to, partner rather with on this?
So Nitin, I think we were the second one. We were not the first ones. I think we have launched it with almost 6-7 customers already.
Okay. And if you have any, just from our understanding perspective, what kind of market share your customers would have got of this molecule?
Very difficult to say. No idea.
Okay. Now, so again, just touching by the earlier point, now, so does this 100 crores, 105 crores, does it become the new base for us to grow on to from here on for the CDMO business?
I think, Nitin, definitely, we have to catch up to some lost time, right, from last year. But, this is something that we are definitely shooting for. Now, whether it becomes a base or not, I guess only time will tell.
Okay, thanks. And secondly, on the generic business, from a growth perspective, what is the primary driver here? Portfolio extension or geographical extension, or how are we looking at growth driving this part of the business?
In trade generics?
Yes.
Yeah, so there are actually 3 expansion levers over here. One is geography. So we have been more focused in the northern states, just following the population density and disease density. We are now expanding to states outside, and those expansion results are beginning to add up. There is a second thing is on portfolio. We are also increasing the number of SKUs. Some SKUs also get trimmed if we don't see a good response, but we are also increasing that. So that's the second lever. And the third, which is the most important one, is our umbrella branding activity, where we are actually investing in exposing Windlas generics as a viable alternative where affordable, authentic, and accessible medicines can be chosen by our customers. So this is where local level brand building activity, some engaging the channel as well as, very, very small level, local level things we are doing. So all these things are sort of adding towards building this momentum. And obviously, there is an overall market growth also. I mean, if you see trade generic companies today have far bigger growth than the overall IPM.
Lastly, you talked about the M&A plans that we've had. Again, just given the volume growth challenges in the industry, I presume other CDMO players also would have suffered along with that, would have had pressure, revenue growth pressure in the last few quarters. So, I mean, how is the market looking like in terms of potential opportunities, for buyouts?
So, we have been mostly looking at opportunities which are able to add a unique dimension. So one of the assets that we looked at was CDMO for international markets, and that's the one that we decided not to pursue. I already mentioned we are looking at market authorizations and other opportunities as well. In the domestic front for CDMO, we were scouting for so in our own injectable we are going after some of the sophisticated injectable dosage forms, and we were scouting for injectables in the domestic market as well in CDMO. We looked at some opportunities but were not very interested. The kind of price that was being demanded was just extremely high. So we continue to scout and continue to look.
Okay. Thank you and best luck.
Thank you. Before we take the next question, reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Dipti Kothari from Kothari Securities. Please go ahead.
Thank you for the opportunity, sir. So my first question was that what is the revenue and margin guidance for the full year? And are we on track to achieve our 2x in CDMO, 3x in trade generics, and 4x in export number in the CDMO business? What is the kind of revenue we are targeting in H2 FY23?
So, ma'am, we are already only giving a sort of a long-term guidance. We are not really giving a quarter or annual guidance. I want to say that with the initiatives, the growth initiatives that I have outlined during the introduction remarks also for this earnings call, they are all those levers which will help us achieve our goal of this growth. So I mentioned new product launches, I mentioned greater supply chain flexibility, and some of the things that we are doing on inventory side. I also mentioned, engaging customers and increasing wallet share from them, as well as growing new customers. So you have also seen that top 10 contribution has, come down from its earlier levels. So those are all very healthy signs of growth in CDMO, and we want to continue to keep walking on that path. And the 5-year guidance, we believe we still have a very good shot at achieving that.
Okay. And sir, what is the capex guidance for the full year?
So for capex, we have just acquired land for business purposes in October. And other than that, there is no major capex other than injectables that has to be spent from IPO money. The maintenance capex of 10 to 15 crores stays for the year as well.
Okay. And what is the rationale behind the buyback just 1 year after raising the money through an IPO?
So a buyback is a strategic decision for us. We have taken that on the basis of accumulation of operational cash needs in the medium term and for returning surplus funds to the members in an effective and efficient manner. So for members of the company, we want to give them an option either to sell their shares and receive cash, or not to sell and get a resultant increase in percentage shareholding in the company post the buyback without additional investment.
Okay. Thank you. That answers my question.
Thank you. Before we take the next question, reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of VP Rajesh from Banyan Capital Advisors. Please go ahead.
Yeah, hi. Thanks for the opportunity. Most of my questions have been answered, but just one on the export side. So how much are we sending to the regulated market versus unregulated markets?
So, Rajesh, currently to reg markets, we don't have any sales. We will start with our commercialization to South Africa, which we are expecting in Q4. But that will be the beginning of it. And our plant approval for Europe also came, last year. And as I mentioned, the incubation period for these markets and, getting into those markets and doing something is rather longish. So as of now, we don't have any revenue in reg markets.
Okay, but you expect revenue coming in next year or the year after that? How should one think about it from the regulated market?
Yeah, as I mentioned, we expect revenues from South Africa in Q4 to begin. Okay. One product we have already gotten approved, and that should commercialize. And the other one is just closely following that. And then, of course, we are also working. We have been approached by some customers to do CDMO for their European demand, and those are again longer term projects because it involves taking batches, exhibit batches, and site transfers and regulatory approvals. So I would say that from export perspective, we should look at a 4-year kind of a horizon and not anything sooner because all of these will be sort of needles in the fire until it finally emerges in terms of that.
Mm-hmm. And I probably missed it. When is your injectable plant going into production? What is the time frame for that?
Yeah, so we are anticipating mechanical completion by end of March, and then there is a media fill and qualification period. Typically, that takes at the minimum 3 months. So we are looking at that. Hopefully, we should be able to be in production, by end of Q1 or middle of Q2 of financial year FY24.
Got it. Okay. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Neelam Punjabi from Perpetuity Ventures. Please go ahead.
Yeah, hi. Thank you for taking my question. Could you give a therapeutic split of your CDMO business as well as trade generics business?
So we have not given a therapeutic business split, but a lot of our business is focused in therapies like diabetes, cardiovascular, neuropsychiatry, and gastro. Yeah, these 4 are our main therapeutic areas. We have not really given out the split for competitive reasons. In terms of trade generics, the market itself for trade generics is more oriented towards primary care, which is in pain, cough, respiratory issues, and antibiotics, and gastroenterology kind of therapeutics.
Okay, this is helpful. Also, could you please highlight how much is the total investment that we're looking for our injectable facilities?
So,
yeah.
Go ahead, Kamal.
So in total, we are looking at 50 to 52 crores of investment in injectables, out of which about 43.5 crores will be from IPO proceeds and rest from our own operational inflows.
Got it. And you said that some of our API requirement is procured in-house. So is it possible for you to share a percentage? How much percentage of API requirement is procured from self-manufacturing?
No, so let me clarify. What I meant was that we have a commercial and pilot plant facility for strategic APIs, those that are patent expiry and are not available in India in time to do the development and launch on day zero. And also those are where we have created highly efficient API process chemistries to utilize a lower pricing and pass on some benefits to our customers also. So this is a more strategic thing. I would believe that the own API contribution is very, very small to our overall API purchases. I would say it's less than 3% or something. But this is a guess. We don't even track it because we always look at this pilot facility as a strategic tool rather than a tool to go backward integration.
Understood. Okay. Got it. And you mentioned that from Q4 onwards, you're looking to commercialize and sell products in South Africa. So are we looking to sell it via a partner or sell it directly or to distributors? How's the model?
So in this case, ma'am, as previously we have shared, our partner in South Africa for these products is Cipla. So we are going to be supplying to Cipla, and Cipla will be selling.
Understood. Okay, got it. Thanks a lot for taking my questions, and all the best.
Thank you.
Thank you. The next question is from the line of Raghav from STC Associates. Please go ahead.
Good morning. Thanks a lot for the opportunity. Mr. Hitesh, the first question was on volume growth in the overall market. As you stated, majority of our growth in the CDMO vertical is driven by new product additions. However, would be good to know the 8% year-on-year growth. Is that driven majoritarily by introduction of new products, or there will be some volume growth there in as well?
So definitely there's a combination of volume and new product launches, and also price changes that are impacting this. So so there will be a positive impact in terms of prices, in terms of growth. There will be a positive impact on volume, and there will be a positive impact on mix. So those products that are a higher price may have had a higher proportion just because of them being new launches. So I would believe that all three of them would be having a role. We have not quantified, and also we are not disclosing the quantification. So, but I would believe that there will be a positive impact on all three of those.
Got it. That's helpful. The second question was on the injectables facility. You said you expected to start production around Q2 FY24. How is our plan there to go to market? I think majority of it will be through existing customers. But again, it would be great to know as to how those discussions end up shaping.
Sure. So we are pursuing, first of all, what we are doing in the injectable space is that we have also added injectable SKUs in our trade generics vertical. So that allows us to build that business. And then once the plant is ready, bring some part of that volume or some selected products in-house to immediately occupy some volume from the facility and give us ability to commercialize, generate data, and essentially content. The second area is that we are also evaluating, building the. We are also in discussions with our CDMO partners regarding the various dosage forms and that we are putting. Obviously, in CDMO case, you have to sort of create the capacity, have it ready, get the quality inspection done by the partner, and get that approval before you are able to supply. So those there will be a period of this evaluation and approvals once our qualification is done for the CDMO part to kick in. But we will begin commercialization with for our own products, which we will supply in the trade generics and institutional market.
Got it. Thank you. I don't have any further questions.
Thank you. Anyone who wishes to ask a question may press star and 1. As there are no further questions from the participants, I now hand the conference over to Mr. Hitesh Windlas for closing comments.
Thank you very much, everyone, for your queries, and we remain committed to delivering on our long-term vision and bringing good results for us all. Thank you once again. Bye-bye.
Thank you.
Thank you. On behalf of Windlas Biotech Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.